NNN properties are the holy grail of quick service restaurant real estate, and I mean that literally. When a Chick-fil-A comes to market, it trades faster and tighter than almost any other NNN asset in the country. The numbers back it up. Chick-fil-A generates over $9 million in average annual sales per location, which is roughly twice McDonald's average, and they're closed on Sundays. If you get a chance to buy a Chick-fil-A NNN, here's exactly what you need to understand. Chick-fil-A deals come in two structures and trade at different cap rates depending on which one you're buying. Ground leases, where Chick-fil-A owns the building on your land, trade at 4% to 4.75% cap rates. Build-to-suit NNN deals, where the investor owns the building, trade at 5% to 5.75%. Entry prices range from $3 million to $8 million plus, depending on location and structure. Lease terms are typically 15 to 20 years with options, and rent bumps of 10% every 5 years are standard. Chick-fil-A is a private company, so there's no formal S&P rating, but the financial strength is treated as investment grade equivalent given their balance sheet and unit economics. The company is 100% corporate owned and operated, no franchisees. What makes Chick-fil-A unique in QSR net lease is that the investment thesis doesn't rest on credit ratings. It rests on $9 million in average per store sales. When a QSR generates that much revenue from a 5,000 square foot building, the probability of that tenant closing that location and walking away from a 20-year lease is extraordinarily low. The corporate model, where Chick-fil-A owns and operates every location rather than franchising, eliminates franchisee credit risk entirely. These locations also tend to be on the best intersections in any given market, which means the underlying real estate has independent long-term value. Even in a scenario where Chick-fil-A ever vacated, a pad site with that kind of traffic visibility has strong re-leasing potential. Let me clearly explain the two deal structures you'll encounter. In a ground lease structure, Chick-fil-A signs a long-term lease on your land, builds their own restaurant building, and maintains it at their cost. Absolute NNN to the land. You own dirt and collect rent. This is the purest passive investment structure in NNN real estate. There is literally no building to worry about. In a BTS NNN structure, a developer builds the Chick-fil-A building and you buy it with the corporate lease in place. You own land and building with an absolute NNN lease covering all costs. Ground leases trade at tighter cap rates, 4% to 4.75%, because the investor has even less risk. BTS deals trade 50 to 75 basis points wider. I want to be genuinely transparent about the considerations here. First, the cap rates are very tight. You're buying a yield of 4% to 5.7%, depending on structure and market. That's not a lot of current income relative to what you'll pay. The thesis on Chick-fil-A is long-term appreciation potential and the highest quality tenant you can get in the QSR category, not maximum cash yield today. Second, Chick-fil-A is a private company owned by the Cathy family. There's no SEC filing, no quarterly earnings call. You're relying on the company's reputation and performance track record rather than public financial disclosure. Third, Sunday closure is unique. Chick-fil-A does 6 days of sales, not 7. The math still works given the per store sales volume, but it's a real structural difference from every other QSR tenant. Chick-fil-A NNN properties don't stay on the market long, and they rarely get marketed publicly before a buyer is found. If you want to be positioned to move quickly when one comes available in Florida, reach out now, not when the listing hits. I'm Ryan Solberg with MaxLife Commercial. Visit maxlifedevelopment.com or call 321-586-2121.